What if I told you that a financial collapse isn't a disaster for everyone? We're taught to believe that when markets crash, everyone loses. That the tide goes out and all the ships, big and small, are left stranded on the sand. But history shows us a very different, and far more unsettling, picture. It shows that for a select few, a collapse isn't an end. It's a transfer. A transfer of wealth so massive, it's almost silent. They don't just survive the storm, they sail through it, emerging on the other side with more power and more assets than ever before. How? They follow a playbook. A secret playbook that has been used for centuries. And tonight, we're going to open it. To understand this playbook, we must go back to the ultimate stress test for our financial system, the Great Depression. A time of breadlines, desperation, and total economic ruin. Yet, amidst the rubble, some of America's greatest fortunes were not lost, but forged. The story you think you know is only half the truth. To understand the crash, you have to understand the party that preceded it. The 1920s in America weren't just roaring, they were deafening. For the first time, ordinary people had access to something previously reserved for the elite, the stock market. And with new tools like buying on margin, essentially borrowing money to buy stocks, it felt like a game you couldn't lose. The logic was intoxicatingly simple. You could put down just 10% of a stock's value, borrow the other 90%, and as the stock inevitably went up, you'd pay back the loan and pocket a fortune. The market became a national obsession. Chauffeurs, waitresses, and factory workers were all trading tips. The Dow Jones Industrial Average nearly quadrupled in just 5 years. This wasn't investing, it was a nationwide gambling fever, built on a mountain of debt. But as with any fever, it was a symptom of a deep-seated sickness in the economy. While the market soared, farmers were going broke and industrial production was already slowing down. The foundations were cracking, but no one at the party wanted to look down. While the masses were piling into the market, a handful of shrewd individuals were watching from the sidelines, or even better, placing bets against the house. Men like Jesse Livermore, the legendary speculator, and Joseph P. Kennedy Sr., father of a future president. Kennedy, a savvy and often ruthless operator, famously decided to exit the market entirely before the crash. The story goes that he knew it was time to sell when his shoeshine boy started giving him stock tips. He reasoned that if everyone was in, the only direction left to go was down. So he converted his holdings to cash and waited. Others were more aggressive. They didn't just get out, they actively bet on the collapse. They began short-selling the market. This is a high-risk strategy where you borrow a stock, sell it immediately, and hope the price plummets. If it does, you buy it back at the new, lower price, return the borrowed share, and keep the difference. While the public was chanting, buy, 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 these contrarians were quietly whispering, sell, sell, sell. They were positioning themselves not just to survive the inevitable crash, but to profit from it immensely. They saw the house of cards for what it was, and they knew exactly which way the wind was about to blow. The end came swiftly. On October 29, 1929, Black Tuesday, the floor fell out. The frantic selling began the moment the opening bell rang. Ticker tapes fell so far behind they became useless. The noise on the floor of the New York Stock Exchange was described as a physical roar of panic and fear. 16 million shares were traded in a single day, a record that would stand for nearly 40 years. In a matter of hours, fortunes built over a decade were erased. The margin calls came in, forcing investors who had borrowed money to sell their stocks at any price to cover their loans, which only pushed prices down further. It was a death spiral. By mid-November, the market had lost nearly half its value. The party was over. The Great Silence had begun. The stock market crash was not the Great Depression, it was the trigger. The real devastation came next, like a series of aftershocks, each one more damaging than the last. The banks, which had gambled with their depositors' money, began to fail. When one bank went under, people panicked and rushed to withdraw their cash from others, creating a bank run that toppled even healthy institutions. Without credit, businesses couldn't operate. They laid off workers. With no jobs, people couldn't buy goods. This caused more businesses to fail, leading to more layoffs. It was a vicious cycle of deflation and despair. Unemployment surged from 3% in 1929 to a staggering 25% by 1933. This wasn't a recession, it was a complete societal breakdown. The American dream had become a waking nightmare. As the country spiraled downwards, all eyes turned to Washington for a solution. What they got, however, would only pour gasoline on the fire. The government's response was, to put it mildly, catastrophic. President Hoover believed in rugged individualism, and was reluctant to provide direct federal aid. The prevailing economic theory at the time was that the market would simply correct itself. It did not. Then, in 1930, Congress passed the Smoot-Hawley Tariff Act, which raised taxes on over 20,000 imported goods to record levels. The idea was to protect American jobs. The result was the exact opposite. Other countries immediately retaliated with their own tariffs, bringing global trade to a screeching halt and deepening the depression worldwide. The government's attempts to fix the problem only made the hole deeper. They were using a playbook for a minor downturn, not a systemic collapse. Now, why does a story from nearly a century ago matter today? Because the playbook used by the rich to survive and thrive is still in effect. Look at the 2008 financial crisis. While millions of homeowners lost everything, those who understood the system, the ones who shorted the subprime mortgage market, made billions. They saw the cracks long before anyone else. Or consider the COVID-19 pandemic. In March 2020, markets crashed in a panic reminiscent of 1929. But what happened next? Governments and central banks injected trillions of dollars into the financial system. For the average person, this meant a small stimulus check. For the wealthy, who own the vast majority of assets, it meant the fastest stock market recovery in history and an explosion in the value of their portfolios. A shocking statistic, during the first 2 years of the pandemic, billionaires worldwide saw their wealth grow more than it had in the previous 23 years combined. A collapse for Main Street was a bonanza for Wall Street. This wasn't an accident. It was the playbook in action: use a crisis to acquire distressed assets at bargain prices, knowing the government will ultimately step in to prop up the system. The playbook has been updated for the modern era. Instead of just cash and gold, it now includes things like cryptocurrencies, global real estate, and private equity. But the core principles remain the same. So what can we learn from this? What are the key pages from this secret playbook? First, liquidity is king. When chaos hits, cash, or assets that can be quickly converted to cash, is your only defense. Joseph Kennedy understood this. He didn't try to time the bottom, he got out completely and waited for the dust to settle. Second, a crisis is a transfer of wealth. A collapse doesn't destroy assets, it just reprices them. For those with cash, a depression is the single greatest buying opportunity of their lifetime. They buy when there is blood in the streets, acquiring valuable companies, real estate, and resources for pennies on the dollar. Third, understand the real rules of the game. The public is taught to buy and hold for the long term. The elite understand that the system is cyclical and prone to collapse. They protect their downside, hedge their bets, and aren't afraid to bet against the consensus when it becomes a mania. This playbook raises a deeply uncomfortable question: is our financial system designed to be stable, or is it designed to periodically fail in a way that concentrates wealth and power at the very top? The patterns of history suggest an answer we may not want to accept. The next time you see a market in turmoil, don't just see the chaos. Look for the quiet, deliberate moves being made in the background. Because the playbook is always in use. What do you think? Is this pattern inevitable, or can it be broken? Let me know your thoughts in the comments below. And if you want to understand more about the hidden forces that shape our financial world, make sure to subscribe and turn on notifications. Thank you for watching.